Hello everyone. In this video we're going to continue our discussion about the adjusting process, and more specifically we're going to be talking about depreciation. In a separate chapter in the future we're going to be talking about long-term assets or long-lived assets, sometimes we call it fixed assets, and we'll spend more details about depreciation. But now we're just going to take an idea about what is depreciation and how we're going to treat it as an adjusting entry in the adjusting process. So fixed assets or plant assets are physical resources that are owned and used by a business and are permanent or have a long life. So typically we have an asset that was going to be useful for 3, 4, 5, 10 years or even longer than that. So example of fixed assets include land, buildings, equipment. In a sense, fixed assets are a type of long-term prepaid expenses. So it's something that we pay for now, but we're going to use over a long period of time. And over this long period of time, it's going to keep losing its value. So for example, fixed assets such as office equipment are used to generate revenue, much like supplies are used to generate revenue. However, unlike supplies, there is no visible reduction in the quantity of the equipment. Because let's say we're using a computer will still be there. It's not like supplies where it keeps shrinking as we use it. But in this case, the equipment, the computer that we're using, it's still there. It's going to exist until it just stops working or it becomes not that productive anymore. So instead, as time passes, the equipment loses its ability to provide useful service. This decrease in usefulness or in the useful life of the asset is called depreciation. So depreciation is the reduction in the value of an asset over its useful life. So this is how we're going to think about depreciation at the time being. All fixed assets, except land, and that's very important. Land is the only asset that is not subject to depreciation. But all fixed assets lose their usefulness and therefore are set to depreciate. As a fixed asset depreciates, a portion of its cost should be recorded as an expense. This periodic expense is called depreciation expense. The only problem with depreciating fixed asset is that we don't reduce the value of the asset directly from its account. So let's say we're depreciating an equipment or a building. We still want to keep the building with its original value, and we accumulate the value of those depreciations that we calculated over the life of that asset in a separate account called accumulated depreciation. So the adjusting entry to record depreciation expense is similar to the adjusting entry for supplies. The depreciation expense account is increased, in other words, we debit it for the amount of depreciation. However, the fixed asset account is not decreased. And that's the key thing that I was telling you about. We don't reduce the value of the fixed asset right away. We use something called a contra asset account called accumulated depreciation. Why we do that? This is because both the original cost of a fixed asset and the depreciation recorded since its purchase are reported on the balance sheet. We want to keep the original cost. We want to show on the balance sheet how much was the value of that asset at purchase. And then we also show how much was used out of that fixed asset. So instead, an account called accumulated depreciation is increased, or in other words, credited. So accumulated depreciation is called a contra account. And to be more specific, it's called a contra asset account. Why we call it contra asset? Because it's opposite in nature. So let's think about an equipment or any kind of asset. Assets, they have a debit nature. Accumulated depreciation is a contra asset account. So it has a liability. It's actually a credit account. It has a credit nature. It's not a liability. So even though it's on the credit side, but it's not a liability, it's not an equity, it's not a revenue. A contra asset is opposite to asset. We just reduce it from its related asset. And because of that, we give it a negative nature or an opposite nature, which is a credit in this case. So this is because accumulated depreciation accounts are deducted from the related fixed asset accounts on the balance sheet. We call them contra asset. So the normal balance of a contra asset account is opposite to the account for which it's deducted. So let's say we have equipment or a building. They have a debit nature. The normal balance of accumulated depreciation would be credited. So because the normal balance of a fixed asset account is a debit, the normal balance of an accumulated depreciation will be a credit. So let's see some titles for some of the fixed assets and the related contra asset accounts. So as we said, land is one of those assets that never depreciate. Okay, so land is land, is going to stay for as long as we're there. So land does not depreciate, and this is why it doesn't have a contra asset account. Building, we just call it an accumulated depreciation dash building or for building. Store equipment, same thing, accumulated depreciation for store equipment. Office equipment, same thing. So the main idea here is that we're going to have separate contra asset account or accumulated depreciation account for each one of those fixed assets accounts that we have. And how we're going to present it on the balance sheet, we're just going to write the value of the building or building with its value and then subtract from it the accumulated depreciation for that related account. So let's see an example. The December 31st, year 3 unadjusted trial balance of NetSolutions indicates that NetSolution owns two fixed assets. They have land and they have office equipment. As we know, land does not depreciate. However, an adjusting entry is recorded for the depreciation of the office equipment on December. So assume that the office equipment depreciates $50 during December. Again, in a future chapter, we're going to figure out how this $50 was calculated. But now let's say it's given to us that the depreciation is $50. It's going to lose value of $50. So the adjusting journal entry on the T accounts would be as follows. We're going to debit depreciation expense and we're going to credit accumulated depreciation for office equipment. This is one of the journal entries that would never change. It's always going to be presented in that way. We debit depreciation expense and then we create accumulated depreciation for whatever asset we are depreciating. In this case, it's office equipment. So you can see here, we have December 31st, which indicates an adjusting entry. Is depreciation expense, that's an expense account, income statement account. Accumulated depreciation, which is a contra asset account that belongs to the balance sheet, $50 each. So you can see that the office equipment as an asset has not changed. We kept it at $1,800. Would not touch the value. But we create a new account called accumulated depreciation and we credit it for $50. And under expenses, we're going to record depreciation expense for $50. So after the adjusting journal entry is recorded, or we can just say the adjusting entry is recorded and posted, the office equipment account still has a debit balance of $1,800. So now we know the original value of this office equipment. And that's the good thing about having contra asset account, is that we can track what was the original cost of that office equipment. So the difference between the two balances is the cost of the office equipment that has not yet been depreciated, or what we call it sometimes as the book value or the net book value. So the book value of office equipment in this case would be the cost of the office equipment, the original cost, which is $1,800, minus its accumulated depreciation of $50. And that would give us a net book value, or simply a book value of $1,750. So this is very important. When we say the book value or the net book value of an asset, we have to think about its original cost minus the amount of accumulated depreciation, how much of the depreciation has been accumulated over its life. So the office equipment and its related accumulated depreciation are reported on the December 31st, year 3 balance sheet as follows. We show the office equipment's original cost, $1,800, and then, by the way, this is not a credit, it's just a tab here. We have accumulated depreciation of $50 between parentheses, indicating that this is subtracted to get the net book value of $1,750. So I hope this is clear for you. It's a very typical kind of journal entry. All businesses, they go for that, or typical adjusting entry to be more correct. And it's always debiting the depreciation expense and crediting the accumulated depreciation for its related asset. So what if we ignored recording this adjusting entry? What's going to happen? What if we omitted it? It's going to create some issues. So the first thing that's going to happen is that our expenses would be understated because we did not record the depreciation expense. And when expenses are not recorded, the net income would be overstated. Okay, so when expenses are understated, net income would be overstated. And when net income is overstated, stockholders' equity would be also overstated. Because remember, net income is going to be reflected later on in stockholders' equity under retained earnings. For the balance sheet, under assets, it's going to be overstated because we did not reduce the value of the asset by the accumulated depreciation. So asset would be overstated. So now let's summarize the adjusting process. And I think we have here like a few slides that would just give us a summary of all the forms of adjusting entries that we can see. So adjusting entries are dated as the last day of the period. Remember that. So in our case here, we had everything December 31st. We cannot have an adjusting entry in a regular transaction day, let's say December 5th or December 10th or January 15th. That's unless this is the end of the period, but this is not very normal. Like usually it's the end of the accounting cycle. Because collecting the adjustment data requires time, the entries are usually recorded at a later date, but yet we do the adjusting entries on the end of the period. Explanation is normally included with each adjusting entry as well. So we need to have a brief explanation that will explain what kind of adjusting entry that was. So let's start with accrued revenues, and this is when service performed but not billed, interest to be received. All of these are considered to be accrued revenue. Remember, the word accrued can be translated or converted into unpaid. So unpaid revenue is that we earned our revenue but we didn't get the cash yet. And here we have an example for accounts receivable and fees earned. So we provided service, we didn't get the cash yet, so we debit accounts receivable and we credit the fees earned. That's our adjusting entry. For accrued expenses, again, that's unpaid expense. So we incurred the expense, okay, but we didn't pay for it. So we have, for example, here, wages or salaries incurred but not paid. Interest incurred but not paid. That's another example. So we debit the wage expense and we credit the wages payable. When we debit wage expense, we are increasing our expense, we're recording our expense, and we are creating this kind of liability called wages payable. And then we have the word unearned revenue. Sometimes we use the word deferral, okay? It's whenever we get paid or we pay for an expense before we get the service. So in this case, unearned revenue, we got paid for a service or product that we're going to deliver in the future. The unearned revenue is a liability, so we need to make sure that we create this kind of liability. So when the service is provided, at the end of the year, we are going to make an adjustment to reduce the liability and recognize the revenue. So here we have unearned rent, magazine subscription, that's another example, fees received in advance of service. All of these are considered to be unearned revenue. So when the service is provided, we reduce the liability by debiting the liability, the unearned rent. And remember, unearned rent in this case, it's a liability, it's not a revenue. And we credit the revenue because we are recognizing the revenue as time starts passing. So revenue is recorded on the credit side. We have another example for prepaid expenses. Here we have an expense that was paid in advance. Okay, for example, supplies used. So we bought the supplies and then we use it later on. So we're going to debit supplies expense and credit supplies. Let's say we paid in advance for insurance. Now the insurance has expired or we used part of it. So we debit the insurance expense and we credit prepaid insurance. Remember, supplies and prepaid insurance, these are assets. They're going down because we use them. And on the debit side, we have supplies expense, insurance expense. This is the amount of expense that we recognize or record in the books. The last example that we talked about is depreciation. That's one of the easier things because it's very typical. It does not change from one situation to another. And by the way, all of these are very typical. And I think practice is very important because once you get exposed to all these kind of adjustments, it gets to be very easy and very logical. So here we have depreciation of equipment and building. So we debit the depreciation expense, and that's an income statement account, and we credit the accumulated depreciation for office equipment. Remember, accumulated depreciation is a contra asset account. It's a contra office equipment account. So it belongs to the asset, but it has an opposite nature. So now we have all the list of all the adjusting entries that we had. And notice all of them took place on December 31st. No cash involved. Every single one of these adjusting entries include an income statement account and a balance sheet account. So we take these adjusting entries and we post them to the ledger. And we see that the cash account was not affected. Nothing happened here. But for accounts receivable, we have a debit of $500. For supplies, we have a credit of $1,240. And that's the posting process. For prepaid insurance, we have a credit of $200, and it says here adjusting on December 31st. Nothing happened to land, nothing happened to office equipment directly. But for accumulated depreciation, the office equipment, that is a new account that was created. It's a contra asset account. We credited for $50. Accounts payable was not impacted. Wages payable was credited for $250. Unearned rent, which is a liability account, was reduced or debited by $120. Nothing happened to common stock, and typically adjusting entries don't affect stockholders' equity accounts. And then fees earned was also credited for $500. Rent revenue was credited for $120. Wages expense was debited for $250. Supplies expense was debited for $1,240. Nothing happened to rent expense, utilities expense. Insurance expense was debited by $200, and depreciation expense was debited by $50. The miscellaneous expense was not affected either. So now we are ready to prepare the adjusted trial balance. So remember, the trial balance is just a list of all the accounts that we have in the business with their debit and credit balances. And we have a column for the account number. The trial balance goes through three phases. We have the unadjusted trial balance, which we prepared in Chapter 2 after recording all the journal entries. And then we have the adjusted trial balance, where we adjust the trial balance with those adjusting entries. So now we have an updated, or what we call it, the adjusted trial balance. And then in the later stage, we're going to close the accounts, and we'll have something called post-closing trial balance. So I just want you to remember that we're going to have three different forms of trial balances. This is the second form, which is called adjusted trial balance. So after the adjusting entries are posted, an adjusted trial balance is prepared. The adjusted trial balance verifies the quality of the debit and the credit balances before the financial statements are prepared. If the adjusted trial balance does not balance, an error has occurred. The good thing about the adjusted trial balance, it makes us ready to prepare the financial statements. So the post-closing trial balance, that's a later stage. After the financial statements are prepared and we close something called the temporary accounts, we're going to have the post-closing trial balance. But now, once we have the adjusted trial balance and everything looks good, we're ready to prepare financial statements. So here we have an example for an adjusted trial balance. And as you can see, we have all the accounts that we had before. We have a few accounts that we haven't seen before, like the accumulated depreciation, the depreciation expense. So these are the ones that were added, and a few other more. But the important thing at the very end, the debit balance and the credit balance are equal. And we still call it the adjusted trial balance. Remember, we need to make sure that this is differentiated from the unadjusted trial balance. Now let's talk about the last part of this chapter, which is doing some analysis for decision making. And here we're going to be talking about vertical analysis. Before we talked about horizontal analysis, now we have vertical analysis. So comparing each item on a financial statement with the total amount from the same statement is useful in analyzing relationship within the financial statement. And we'll see how this works with a good example. So vertical analysis is the term used to describe such comparisons. So in vertical analysis of a balance sheet, each asset item is stated as a percent of the total assets. Each liabilities and stockholders' equity item is also stated as a percent of both the total stockholders' equity and liabilities, which is also, by the way, equal to the total assets. In vertical analysis of an income statement, each item is stated as a percentage of the biggest number of the income statement, which is typically the revenues or the fees earned. Vertical analysis is also useful for analyzing changes in financial statements over time. So let's see this example. And this is an example for an income statement. So you see here, we have the value of the income statement for 2007 and 2006. You can see there were some increases. But here we're comparing like all numbers to the biggest number, which is the fees earned or the revenue. So of course the fees earned was going to take the percentage 100%. Same thing here. We compare it to the 150, it's 100%. And now we take each one of these accounts, like the wage expense, rent expense, utilities expense, and we divide it by the largest value, which is the fees earned. So let's say we take 60,000 divided by 187,500, and that's going to be 32%. 15,000 divided by 187,500, that's 8%, and so on. So net income, for example, which is an important number on the income statement, it's 95 divided by 187,500, it's 50.7. So 50% of our fees earned is translated into net income. How was that last year? For last year, if we look at the 70,800 divided by, the 79,200 divided by the 150, that's 52.8. So we used to be 52.8, now it's 50.7. So 50% of our fees earned is translated into net income. It used to be slightly higher in the previous year. You can see that wages expense used to be only 30%. Now it's 32% of our fees earned. So it's a good thing that you compare how the expenses and different items of the income statements are compared to the amount of fees earned. So for example, even though rent expense has increased by 3,000 from 12 to 15,000, but the percentage to the fees earned is still the same. It's 8% versus 8%. So I think the vertical analysis is also useful to show you like how you're doing compared to the biggest number, or to compare to your fees earned, which is the biggest number on the income statement. For balance sheet, we're going to use the total assets. So it gives you an idea about like how these numbers are compared to another something, to another value, which is a relative kind of comparison. And then you can use these percentages over time to see whether there's growth or decline in each of these accounts. So by this, I conclude chapter 3. I hope this was helpful, and please keep studying, keep reading. It makes a big difference, and I wish you all the best.